Hey folks, it's Simon here with your Tao Daily for Wednesday, the 19th of March, 2025. Today was Fed Day. We had the FOMC meeting. Now, the Fed concluded its meeting by maintaining the Fed funds rate steady. There was no cut, there was no hike. That was broadly anticipated. The Fed also released updated summary of economic projections where they raised their unemployment forecast to 4.4% for 2025, up from 4.3%. They also increased their core PCE inflation estimate to 2.8% from 2.5%, and they lowered their GDP growth forecast to 1.7% from 2.1%. That's got a lot of people screaming stagflation. Look, it's not stagflation. It is just below trend economic growth with actually lower than average inflation. If you go back to the 60s, slightly higher than what we've been used to in the post-global financial crisis period. But there's really nothing like this. It's not a great set of numbers, but it's nothing to get super worried about. So why did the market rally? Well, the Fed are still calling for 2 rate cuts this year. The market is looking for 2 rate cuts this year, 3 over the next 12 months. They have also signalled a slower pace of quantitative tightening. All right, that reduces the monthly cap of Treasury securities running off, and this helps to ease financial conditions. And more than anything else, you know, the market had kind of sold off yesterday fairly hard into the FOMC meeting, probably just a little bit of relief. Now, looking at the S&Ps here, we've got the SPY chart in front of us. You see how it's kind of bumping against this resistance level. This is like a really critical level, and we've closed at that level, twice, right at the top end of this channel. Now, if we're going to fail here, a retest of the lows is on the cards. But if we can just push through this, I think we see a pretty rapid rally because a lot of people who shorted this breakdown will be forced to short cover. So counter trend rally still on the cards here, and just given how positioning has been rinsed and sentiment is incredibly bearish right now, you know, I sort of give the edge to the bulls here. Breadth was good. All 11 sectors finished in the green, well, with one exception. The strongest performing sectors are the most kind of bombed out ones. XLY, consumer discretionary, was up nearly 2%. We had tech was up about 1.3%. We had industrials up about 1.3% as well. The worst performing sector were the more defensive ones. We had utilities up 0.37, real estate was basically steady, and XLP, actually the worst performing sector of the day, absolutely steady, 0% gain. So the market's still kind of wrestling with whether we're in a risk-on or risk-off environment. Certainly today it was more risk-on, as evidenced by those more growthy and techie sectors of the market outperforming. That's what I got for you today. I hope it helps, and I'll catch you tomorrow. Thank you.